Good morning to everyone. Hope everybody is doing well. Welcome to the first topic of chapter number 3, which is accounting equation. So let's start and know, and then later on we will do the example of this topic one by one. Let's start. What is accounting equation? Accounting equation is a simple expression of the fact that at any point in time, the assets of the business will be equal to its liabilities plus capital of the business. What does it mean? Let's suppose we have a transaction and we are recording. So after that recording of that transaction, we should have updated financial position of the business. Like after every transaction, we should know that how much assets do we have in the business right now, how much liability do we have, and how much capital or equity do we have in the business. So the benefit of using accounting equation is that it gives updated, or here I'd say like at any point in time, it shows us the financial position of the business. Like after every transaction, we know that how much asset, liability, or capital do we have, as I said like previously. We have alternative to accounting equation, which is a balance sheet, or we can say statement of financial position. Balance sheet also shows the financial position of a business, but it shows at one point in time. A balance sheet will always satisfy the accounting as shown above. Like I said before, these accounting equation and balance sheet works same, but the only difference is what a balance sheet process is a long process. It means like first of all we have to do journal, then we have to do ledger. After the ledger we should prepare trial balance, and then adjust to the trial balance, and then statement of profit or loss. After the profit or loss we should make balance sheet, which is like a long process, and then we make this at the end, mostly at the end of the quarter or at the end of the year, we make balance sheet. What about accounting equation? The benefit of accounting equation is what, like we know after every transaction. After every transaction, we know that what is the financial position of the business. And balance sheet, we know at specific time, like at the end of the quarter or at the end of the year. What is the formula for accounting equation that we should follow? We know the formula I mentioned here is assets is equal to liabilities plus capital. If this formula does not equal after every transaction, it means we are doing something wrong. It means our balance sheet is not equal. So it should be equal. We can also write this formula in another way: assets minus liabilities is equal to capital or equity. So this is another way. Let's suppose, what does this formula mean? Let's suppose in the business right now we have 100,000 assets. We have 20,000 liabilities, which is equal to 80,000 capital. What does this mean? This means right now in the business we have 100,000 assets, but this 100,000 does not all belong to the owners or the shareholders of the business. This 100,000 does not belong all to the owners or the shareholders of the business. Out of this 100,000, which is 20,000, here I have, this belongs to the third party or the lenders. That 80,000 belongs to the owners or the shareholders. So mean this 80,000 is the net interest or the net investment of the owners in the business. Okay, I hope you get what is the accounting equation. But before starting the counting question, before I start the example, I should touch these two concepts in accounting, which is very important. First one is dual effect concept. What does this mean? Here it means that every business transaction has an equal and opposite effect. I mean, if we have a transaction in the business, it should have dual effect, or we can say double effect. If it does not have double effect, let's suppose one effect means this transaction is wrong. Let's suppose if I say example, let's ABC company bought a car. If I say just like this one, bought a car. So in this transaction, we only have one transaction, like one effect, only a car. I didn't say either on credit or cash. If I have this kind of transaction, it means it is wrong. I should write like ABC company bought a car, cash 1,000. Now it has two effects, two effects. One is car and the other is cash. So this one, car, this increase, cash, this decrease. So like this. In every transaction, we should have double or opposite effect of the transaction. I hope you get this concept. Business entity concept. What does this mean? For the purpose of accounting for business transaction, the owner of the business is a separate entity for the business itself. This concept means, let's suppose I'm starting a business. My business name is PKF. So if I invest 100,000 or let's suppose $50,000 in the business, it means if I see a transaction from my point of view, personal point of view, Parvez point of view, it means my 50,000 is decreased in my bank account. But at the same time, in my business account, 50,000 increase. So my accountant should record transaction from the business point of view. I mean, he should record the transaction from the business point of view or owner point of view. I mean, the owner and business are separate from each other. On the owner account, money decrease, 50,000 decrease from his account, bank account. In the bank account, sorry, in the business account, 50,000 increase in the bank account. So we should see transaction from the business point of view. Okay? And it means the owner and business is separate from each other. So let's start accounting equations. Let's start by doing example. The transaction of a new business in its first 5 days are as follows. We have six transactions. Let's record one by one. Okay, before recording the transaction, we should know first of all, we should know which element of accounting or financial which element of accounting does it have? Either it should be asset, it should be liability, it should be income, it should be liabilities or equity. We have 5 elements of accounting: assets, liabilities, income, assets, liabilities, income, expense, and equity or capital. So we have 5 elements. Each transaction will have these 5 elements of accounting. We should know which one it has. Once we got that one, the second step, we should know which one increase and which one decrease. So we should know that one as well. So let's do this example. I'm going to make a table. Description, assets, liabilities, and equity. Let's suppose day, description, assets, say equal to liabilities plus capital. Let's start from the first one. Day one. Okay, day one, this one. Avon commenced business introducing 1,000 cash. So in this transaction, we have two elements of accounting. First of all, we have cash. And the second one, we have capital. Means when commences business, started a business, so we have cash in capitals. I will write 1,000 under the cash, under the asset, which is our asset. It doesn't have, this transaction doesn't have liabilities, it's 0. It has capital. How much capital? It's 1,000. So if you see this one, now how much total we have in the business right now? We have 1,000 assets, 0 liabilities, and 1,000 capital. See, like after the day one, we know in the business right now we have 1,000 assets. We don't have liabilities, and we have 1,000 investment. So let's start day two. Day two, bought a motor car for $400 cash. Again, we have two accounts here. One is cash and the other is car. Both of them are assets. So one asset increase and the other asset decrease. So car increase. As I said, first of all, we should know the element of accounting. The second step, we should know which one increase or decrease. So cash decrease. So I will write down by how much we bought a 400. So minus 400. So brackets in accounting means minus. In car, I will write positive 400. So after this transaction, how much total we have right now again? 1,000 minus 400 plus 400 again equals to 1,000. 0 liability we have and 1,000 capital we have. If you see, our equation equals our we have 1,000 assets, 0 liabilities, and 1,000 capital. Let's start day three. Day three. Obtain a 1,000 loan. The business obtained 1,000 loan. So we have two elements again here. One is cash and the other is loan. So cash is asset and this increase. Loan is liability and this also increase. I will write cash under the asset column, which is 1,000. At the same time, I will write 1,000 in liabilities, so 0 equity. So let's update it. How much total we have again? So we have 2,000 assets, 1,000 liability, and 1,000 capital. Let's start number 4, day 4. Purchase goods for 300 cash. Again, day 4. We have two accounts. One is cash, the other is goods, or we can also call inventory. So both of them are assets. This one increase. This one increase. And inventory also increase. So our cash decrease. Really sorry, my apologies. So cash decrease. Why? Because we paid cash. So day 4, purchase goods for 300 cash. So I will write in brackets minus 300 and plus 300 inventory. So after this transaction, if I update our total, so we will have again 2000. Why 2000 minus 300 plus 300 is equal to 2000. 1000 liability and 1000 equity. This is total right now after every transactions. You can write total after every transaction or make it at the end of like month or day 5. Day 5. Day 5. What is day 5? Purchase goods for $300 on credit. What does it mean? Credit means accounts payable. We didn't pay, we will pay later on, which call in accounting accounts payable. Accounts payable is our liability. So again, we have two things here. One is goods, which increase, and the other is accounts payable, which increase this one as well. So how much we bought it? 300. So 300. At the same time, my liability also increased 300. If I update this one, now at the end of the day 5, what do we have? We have 2,300 total assets, total liabilities 1,300, and total equity we have 1,000. So let's do the last transaction. Again, day 5. In this day, we have two transactions. Sold goods for $400 on credit. So we have two transactions. One is account receivable. Account receivable, it means if we sell something on a credit, it means we didn't receive the cash right now, but we will receive later on. So we call them in accounting account receivable. And this is our asset. And this one increase. And we sold the goods. And this is an asset again, and this decrease. So one increase, the other decrease. So how we can do this one? 400. So account receivable, which is asset increase, account goods, which is asset decrease, 400. So let's do again total. So how much do we have? 2,300 plus 400 minus 400. So again equal to 2,300. 1,300 is our liabilities and 1,000 is our equity. So this is the end of the question. What does it mean now? In day 5, and right now in this business, the total assets do we have, which we have is 2,300. This is the total assets do we have. In this business, this 1,300 belongs to somebody else, lenders. And this 1,000 belongs to the owners or the shareholders. So our net investment or the residual interest of the owners or the shareholders in the business is 1,000. Okay, so this is shows the financial position of business at any point in time. So I hope you get this one. If you have a question, you should tell me. Or if not, if still you guys have a problem, I will solve another question. Until you get it, then I will move to another topic. Thank you so much. Have a good day.